Do you quietly suspect your index fund is the naive choice? That unease isn't ignorance. Nobody ever walked you through the arithmetic underneath it. So tonight, 6 reasons the index quietly beats the experts. 6 separate pieces of arithmetic, each one you can go and check yourself. And the 6th is the honest one, the strongest case against the other 5, told properly. By the end, you won't have to take anyone's word for any of this, including mine. Let me set the scene, because I think you know it. A kitchen table, late on a weeknight, 2 tabs open on a laptop. On the left, a beautifully made page for an actively managed fund, a photograph of someone in a good coat, a paragraph about proprietary research and disciplined conviction, a track record laid out in confident blue bars. On the right, a page for a broad index fund. No photograph, no philosophy, 1 line describing what it owns, and a cost figure so small it looks like a typing error. And the slightly embarrassing question sitting in the room with you: why does the plain one keep winning? Not sometimes, not by luck, over decades, and by a margin that turns up in every serious scorecard anyone publishes. 6 reasons. Let's take them one at a time. Reason 1, the arithmetic that comes first. Before we talk about anybody's skill, there's a constraint that skill cannot get around.
Every share of every company is owned by somebody. There are no unowned shares floating in the air, which means the return earned by all investors together before costs must equal the return of the market itself. It cannot be higher. There's nowhere for a higher number to come from. That's not a statistic, it's a definition, and it was written down with unusual clarity in early 1991 in a 3-page paper in the Financial Analyst Journal by William Sharpe, who had won the Nobel in economics the year before. The paper is called The Arithmetic of Active Management, and its argument is almost stubbornly simple. Before costs, the return on the average actively managed dollar equals the return on the average passively managed dollar. After costs, the actively managed dollar must earn less, not usually, not in most decades, necessarily as a matter of accounting. Picture a field farmed in common. Some farmers are genuinely more skilled and go home with more than their acreage would suggest, but every extra sack came out of somebody else's cart because there is only one harvest. Skill only ever moves the harvest around. And the skilled farmers charge for their skill. The cart hire is due whether the harvest was good or thin. The index investor is simply the person who takes their acreage share, pays almost nothing for the cart, and walks home.
So the question you've been asking yourself, am I clever enough to pick a winner, turns out to be the second question. The first one is structural. The pool of market-beating returns is finite, and it shrinks by exactly the amount everyone pays while chasing it, which raises something uncomfortable about the evidence itself. Because if the arithmetic is that unforgiving, you'd expect the published results for active funds to look bad. They do. What you might not expect is that the published results are the flattering version. Reason 2, the funds that left the room. There's a free public document called the SPIVA scorecard, published twice a year since 2002 by S&P Dow Jones Indices. I mentioned that it's free and public because you can read it yourself this week, and I'd rather you did that than trust my summary of it. Its headline finding across the long windows is roughly what the arithmetic predicts. Over 20-year periods, something like 9 out of 10 actively managed U.S. large-cap funds have failed to beat their benchmark. But the number I find more revealing sits in a quieter column of the same report, the survival column. Of the funds that existed at the start of a 20-year window, only around a third were still operating at the end of it. Think about a photograph taken at the finish line of a marathon. Everyone in the frame finished.
What the photograph cannot show you is the runners who stopped at mile 18. And if you judged how hard marathons are from finish line photographs, you'd conclude that almost everybody finishes. A fund that performs badly for 5 years does not stand in the frame holding a sign. It's merged into a healthier fund in the same family, and its record goes with it. The disappointing years leave the room. The family's average improves. Nobody's investors were made whole. So when you see an impressive track record, ask what happened to that fund's siblings and deflate the advertised odds. Whatever they are, the real ones are worse, because the losers have already been quietly escorted out. 2 reasons in, and neither one has required a single opinion about anybody's talent. The third one is the same, except this one you can calculate on your phone right now, and it's the one that costs most people the most money. Reason 3, the toll on every mile. A fee reads like a slice off your profit. Look at how it's actually charged. A levy on your whole balance every year. in the years you gained and the years you lost, which means it compounds against you at precisely the same rate your money compounds for you. Let's do the arithmetic out loud, slowly, and then you can check it. $10,000, left alone for 30 years.
At 7% a year, it becomes $76,123. Now the same 30 years, the same market, the same companies, the same everything, except 1 percentage point a year is handed over, so 6%. That $10,000 becomes $57,435. The difference is $18,688, very nearly a quarter of everything the money would have become. 1% a year over 30 years costs you about a quarter of the final result. That's the sentence. It's illustration, not prediction. Nobody knows what the next 30 years return, but the ratio holds regardless of the rate you plug in. And there's a second toll on the same road, less visible. Turnover. A broad index fund trades only when the underlying index changes, which in a typical year is a couple of % of what it holds. An actively managed fund earns its adjective by trading. Morningstar's figures for the average actively managed U.S. equity fund have historically run somewhere close to 2/3 of the portfolio turned over in a single year, against those low single digits for a broad index fund. Every one of those trades carries a spread and a cost. In a taxable account, many of them also realize a gain, which is how a genuinely strange thing happens.
In 2022, a year when the S&P 500 lost roughly 18% on a total return basis, a great many actively managed funds still handed their shareholders a taxable capital gains distribution. A tax bill in a losing year is a peculiarly demoralizing envelope to open. There's a piece of research worth naming here. In 2016, Russell Kinnell at Morningstar published a study called Predictive Power of Fees, testing what actually forecasts a fund's future performance. The expense ratio came out as the most dependable single predictor across the asset classes and periods examined. Cheaper funds succeeded at markedly higher rates. Cost is the one variable in this entire enterprise that you can both control and predict. The charge is knowable to the penny long before the return is knowable at all. But none of that touches the objection you're probably still holding. Some managers do beat the market. Not a myth, a fact. So why not simply find one? Reason 4. Last year's champion. Let me be careful here, because there's a cheap version of this argument and I don't want to make it. The cheap version says professional managers are fools. They aren't. Many are extraordinarily capable, deeply researched, disciplined, working with resources you and I will never have. And that capability is precisely the problem.
The market price of anything is set by thousands of such people arguing with their own money. Beating that price consistently means being reliably better than the collective judgment of everyone else who is also good, which is the turn this whole episode rests on. The question was never, can anyone beat the market? Someone always does. The question is whether you can identify them in advance, from the outside, using the only evidence you're ever shown, their past record. In 1997, Mark Carhart published a paper in the Journal of Finance called On Persistence in Mutual Fund Performance. He examined U.S. equity funds from 1962 to 1993 and found that what looked like durable manager skill was largely explained by momentum in the underlying stocks and by differences in expenses, rather than by ability that stayed put. And the test still runs. There's a companion to the Spiva report called the Persistence Scorecard, and it does something almost childishly simple every year. It takes the funds in the top quartile of performance and asks how many are still in the top quartile a few years later. The recurring answer across editions is that persistence sits close to what pure chance would produce. In more than one edition, out of several hundred top quartile U.S.
Equity funds, not a single one stayed in the top quartile in each of the following 4 years. Not few, none. There's a cost hidden inside all this switching too, and it's been illustrated cleanly by J.P. Morgan Asset Management in their Guide to Retirement. Over the 20 years from 2003 to 2022, $10,000 left fully invested in the S&P 500 grew to roughly $64,800, an annualized return near 9.8%. The same money, missing only the 10 best trading days out of 20 years, ended near $29,700, around 5.6% a year. 10 days, less than half the money. And here's the detail that explains why nobody sidesteps this cleanly. 7 of those 10 best days happened within 2 weeks of the 10 worst days. The best days hide inside the worst weeks. Anyone moving in and out is playing for a handful of dates without knowing which ones they are. So a 3-year record tells you roughly what a coin's last 3 flips tell you about the next 3. Which leaves a question I suspect you've never been asked. If the winners can't be identified in advance, where does all the return actually come from? Reason 5. The few ships that carry the cargo.
We tend to imagine stock returns the way we imagine heights in a crowd. Most people near the average, a few tall, a few short. That intuition is wrong, and the extent of it is the reason this reason exists. In 2018, Hendrik Bessembinder published a paper in the Journal of Financial Economics with a deliberately flat title, Do Stocks Outperform Treasury Bills? He looked at all 25,332 U.S. common stocks that existed between 1926 and 2016. 57.8% of them delivered a lifetime return worse than 1-month Treasury bills, worse than the safest instrument available. The median stock's life in that database lasted about 7.5 years, and of the roughly $35 trillion of net wealth those stocks created above Treasury bills across 90 years, all of it came from about 4% of the companies. Picture a harbor in an old trading port, 100 ships leaving on the spring tide. Most come back roughly as they left, or limp home lighter, or don't come home. A very small number return so laden that they pay for every other voyage in the fleet, and then some. 2 investors stand on the quayside. One studies the captains, the hull design, the manifests, and buys shares in 30 carefully chosen ships.
The other buys a small share of every ship in the harbor. The careful one might pick beautifully, but if those 30 ships happen to exclude the handful carrying the cargo, no amount of diligence gets it back. Nothing in their research recovers a voyage they didn't own. The other one cannot miss them. No insight required. They'll own every great voyage at its proper weight, without ever having identified one in advance. That's the mechanism, and it's worth naming plainly. Diversification usually gets explained as a way of lowering your expectations. Go back to the harbor. It is the only reliable way to end up holding the ships that carried the cargo. 5 reasons, and every one has run in the same direction, which is exactly when you should get suspicious of me. So let's do the 6th one properly, and let's start it with the strongest case against everything I've just said. Reason 6. The orchard that replants itself. Here is the objection at full strength, with real history, and I'm not going to soften it. An index can go nowhere for a very long time. Japan's Nikkei 225 closed at 38,915 on the 29th of December 1989. It did not close above that level again until the 22nd of February 2024. 34 years.
Anyone who tells you markets always recover quickly has not sat through that. And this was not some obscure corner of the world. At that peak, Japan represented roughly 40% or more of the entire planet's stock market value. Closer to home, U.S. stocks had their own barren stretch. The decade from 2000 through 2009 produced a cumulative total return of roughly -9% for the S&P 500, the only negative calendar decade in the modern record, with the price index down around a quarter over 10 years. And individual companies simply do not always come back. Lehman Brothers went to zero in September 2008. Kodak filed for bankruptcy in 2012. One of the largest financial institutions on Earth has never regained its 2006 share price, even after consolidating its shares 10-1 in 2011. That's the case. Take it seriously. Now, the protections specifically. And the first one is the reason this chapter has the name it does. An index does not need anybody to decide that a company is finished. There was no meeting about Lehman, no conviction, no capitulation, no wrenching admission of error, and, importantly, no capital gains event for the holder. The failures were simply replaced at market weight by whatever was growing.
It's an orchard that replants itself. Dead trees come out, new ones go in, and the orchard outlives every tree in it. Your loss on any single company is capped at its weight. Your gain on the survivors is not capped at all. Second, Japan is an argument for owning the world rather than an argument against indexing. An investor who owned a global index in 1989 held Japan at its world weight. Painful, survivable, not the whole portfolio. Third, that lost decade landed very differently on a saver than on a lump sum. Someone contributing monthly from 2000 through 2009 bought their largest number of shares at the decade's lowest prices. Their personal experience looked nothing like the headline. And fourth, the honest one. An index gives you the market's return minus a very small cost. It says nothing at all about whether the market's return will be good over any particular 10 years, which is exactly why a horizon measured in decades matters, why geographic breadth matters, and why sequence of returns risk, the plain fact that a bad stretch arriving just as you begin withdrawing does far more damage than the same stretch arriving 20 years earlier, deserves a deliberate plan rather than a hope. Two things held at once. The index is not a promise of good decades, and it is still the structurally sounder way to own them.
So let's go back to that kitchen table, the two tabs, the glossy page and the plain one. The tabs haven't changed. You have, because the question has changed shape. You sat down asking whether you were missing something the professionals know. You're getting up with a different question, and a better one. What does the arithmetic actually allow? And the arithmetic turns out to be a kind of permission. You don't have to be right about which manager, or which decade, or which handful of companies out of 25,000. You only have to own the whole thing, cheaply, and then get out of its way. Notice the strange emotional shape of that. The plain choice turns out to be the well-evidenced one, and there's a particular quiet that comes from holding a position you could defend in detail to anyone who asked, the quiet of having seen the numbers underneath it. 6 reasons: ownership, survivorship, cost, the non-persistence of skill, the 4% of companies that carry everything, and the honest limits of all of it. Not one of them asked you to predict anything. So the unease you came in with, that you were doing the naive thing, that somewhere out there smarter people were quietly getting more, I hope it reads differently now. You already had the position. You'd simply never been shown the argument underneath it. None of this asks you to do more.
It asks you to do less, on purpose, for longer than feels natural, and to stop reading your own decision as a compromise. If this was useful, subscribing is the quietest way to keep these coming. And I'd genuinely like to know which of the 6 landed hardest for you: the fee arithmetic, the ships in the harbor, or the honest one about Japan. Tell me in the comments. Until next time, take your time.